Hey, everybody. Can you all hear me? Give me a thumbs up if you can. Perfect. Thanks, Vince. Hey, Doug. Good to see you. How you doing? We have got to connect. I know Doug and I are friends. We go way back. So Doug does some crazy stuff with propane on vehicles and builds things. So it's good to see everybody. And as people are joining us, welcome to Real Estate Wealth Lab. And we've got a great event planned for you for the next few minutes, an hour. How's that? Jennifer, how you doing? Great to see you.
Good, Naran, great to see you as always, and all these wonderful REWL members here. That's fantastic. We've got Tara from Leduc, Alberta, and Duncan and Leanne. Great to see you, and Olu.
Yes, Olu's in the house. Yeah, here's a trade secret. Olu's daughter and my son go to the same school. See? Stuff you didn't know.
Small world. That's awesome. Really good. Well, shall we get this show on the road?
We should get this show on the road. Before you do,
yes, sir.
I just, you know what's interesting is that this week I've had two different people reach out to me, and one of them was actually in tears because they were in their, later on in their years, and they hadn't done anything to really invest, and retirement was coming up. And the money that they've got has been in stocks, and it hasn't done as well as they hoped for. I keep meeting, Jennifer, people that have at the older generation. When I say older, I mean like 40s, 50s, 60s. And two things have happened to them. One is they have gone astray on being able to really reserve and preserve some nest egg for the future. And now they're trying to play catch up. Or the second thing is, as they've lived their life out, all of a sudden, I think the busyness of life gets in the way, and they're looking back at it and going, the dreams I wanted to accomplish, I haven't been able to do. And man, that's a scary place to be in, but it's also an encouraging place to be in, because I've been there. And I know what it's like to have to reimagine your future. And I know all of us have, right? I know, Jennifer, you have, where we've had to kind of retool, reset, and re-engage with ourselves to create the best possible future that is possible. So if you're in the room and you're feeling like, you're kind of off the rails, we've got you. We get it. And we are good and skilled at helping you get back on track, because we've had to do it in our own lives.
So, Lauren, thank you for that. And that's actually really, you don't even know what I'm going to talk about today. And I think
I have no idea. It's real estate and stuff.
Divine timing.
Hey, Julius, out for a walk.
Yeah, that's great, Julius. I think it's I'll be showing a couple of slides just generally about the value of real estate and the power of starting now and staying in it. So even if you are and then we all have the strategies and the abilities to accelerate it. However, over the long time, there's some pretty cool stats that I have to show. So if you're out there with your clients or, looking to get investors or whatever have you, we've got some data that you can say, what's real estate done for you lately? And here you go. So I'll get into that in a little bit. So thanks, Moran. Awesome. And you're right. We're here for you.
All right. Do you want to share your slide
deck?
Yes,
I do. I got that. Yes. I sure do. Ta-da! Here we are. Very good. Okay. I think everyone knows who we are now, hey?
I think so.
Chief Intelligence Officer with the Real Estate Wealth Lab. That means I'm into research and geeky stuff so that I can keep all of you investors informed of what's required and what's coming up now. And Naran.
I am the Leadership Officer, which means that I like to push people and prod people and lead people and drag people as I drag myself along so that we engage with what's going on.
Absolutely. And this is where we are today. We're at our research lab. Today, we're going to be talking about Burnaby, And go ahead.
So we have a legal disclaimer, and most of you will know what this means. If you are doing a deal, you need to consult your own lawyer, accountant, and such. We're sharing with you what we are doing and what we are seeing. So if you want to take a screenshot of that, you can. A couple things. If you are new to our group, we do encourage you to ask questions, say hi, engage, reach out to us. Any feedback or thoughts or ideas, bring it. If the only thing we ask is that you don't solicit or sell in this meeting. This is being recorded. It'll be available for you in the REWL member back office, the portal. So, Jennifer, this is our agenda for today. We're doing a quick introduction. I don't think it'll take us till, we've got the times wrong on it. 7 to 7:30.
You're right. It is wrong. This is going to be way shorter.
But,
my apologies.
But we're going to speed it up. I know that you are brilliant at bringing in information about what's going on in real estate. And my goodness, if we ever really need to slow down and take a look at what's going on in the world economically, politically, how the culture is shifting and how things are happening, this is the time. So that's what we're going to do. And then you're going to do a deep dive into Burnaby, BC. Is that correct?
Yes, sir.
So Burnaby, I've never invested in Burnaby. And some of you will be sitting here going, man, I can hardly wait. I'm ready to go invest in Burnaby. And there are others of you that go, I don't want to go to Burnaby. If you don't want to go to Burnaby, pay attention, because the same process and questions that are answered, you need to apply to the area that you are interested in.
And I see Vincent saying that he's got family in Burnaby, and you may really want to consider getting something in Burnaby, because I've got some wild data that, holy smokes. So,
all right, looking forward to it.
Awesome. So thanks, Moran.
We have live events going on. Just take a screenshot of this slide. It will give you the dates. It's on Wednesdays of every month. We have a community lab event on the first and third Wednesday of every month. And the research event, which is today, that is the fourth Wednesday. And of course, on the second Wednesday, we have market leaders, where we will interview a leader within the real estate space. Mastermind. This is where we get to hang out together, and we help you and the group together. We coach in real time, not just us as a leadership, but as people in our group. And we will help leverage each other's expertise to help each of us move forward. You're probably hearing a dog barking in the background. That's my German Shepherd. I think he's upset with somebody walking across the front of the room, the house.
And he helps you with your property management. So
yes, I got stories.
I know. That's awesome. Excellent. Okay.
REWL Lounge. We are going to be how number of you joined us for our REWL Lounge, and thank you. It was great to connect. What we found is that, connecting on Zoom is fun, but it's not as cool as connecting in person. So really, I'm looking forward to having some connecting, at least in Toronto, with a few of you in my area. We're pausing the REWL Lounge until next year. Thank you for those of us who joined us. It was great of you to belong. I'm really stoked about the community that I'm a part of. We're coming into the Christmas season, and I'm noticing that people are really swamped for time. So we're going to be kind of putting a pause button on the REWL Lounge. Watch for the rebirth of it in the new year.
Awesome. Yes. Okay.
You're on,
That's
Jennifer.
it. Here we go. All right, buckle up, ladies and gentlemen. So this is your research. This is what you need to know to help navigate the confusion and the crazy headlines that are occurring right now. And I'm primarily going to be focusing, I have some subdued rants. There's nothing going to be too crazy in my rants. However, there's a couple of key things that you'll be able to take away. And I'd like you to consider it from the hat of, if you're attracting other investors, or if you're talking to other investors and you want them to work with you or whatever have you, there's a real calming aspect that you can bring to the confusion out there. So by having this, insight and these kinds of data sources at your fingertips, I'm hoping that you can help shed some calmness in the world of real estate and be those leaders, knowing that you're armed with more information than most, and the headlines really suck right now. Okay, so we're going to be talking about interest rates primarily, and we're going to be talking about the prices. Like, hey, who wants to know where do you think prices are going to go? Yes, I'm definitely going to be focusing on that and interest rates. And those are the two main ones. And then a little bit about just some neat data on the power of real estate over time. Back to what Naran was saying in terms of planning in advance and planning now. So what we also look at is the business cycle of real estate, which is the real estate cycle. And we look at contraction, stabilization, expansion, and we're able to identify how long the duration of those particular cycles. And we're starting off right off the bat. We're generally speaking, we're going into like a softening. It is a contraction. However, it's very, very going to be very tame, quite light, and it will last through 2024. Now, what does that mean for real estate investors? It means, I'm telling you the golden nuggets right now, so take notes. It means get capitalized, have money available, start preparing make sure all of your properties are cash flowing exceptionally well, and then be prepared to buy. Start buying because it's going to be soft. You're going to be wanting to buy in this time. This is acquisition time, and then hold for the long term. All of our 30 plus indicators are showing, as we look at the GDP and the jobs and the gross output and the people and the inflation and the interest rates, are showing that here, I'll go to this slide, showing a couple of years of a bit of a softening, but we're looking out 10 years. And over the 10 years, and you're going to see some other data that we've been saying this since we opened the doors. So there's other data that's now showing up that's really affirming this. So in many respects, it's a thank you, for being here and also paying attention, because this kind of information that we've already been able to project hopefully will be helpful for you. So
Jennifer,
yes, Naran.
If I can just interject and ask a question. When you say softening, what do you mean by softening? Does it mean that my 12-unit or 16-unit apartment building is now going to become a 1-unit building? Is it going to implode? Or can you give us some insight into what? I know there's no crystal ball to see clearly, but what do you feel?
I love that you asked that question. And I actually have data for that. So thank you, Naran. So we'll get to actual specific numbers, because I'm primarily today, I've got those numbers for the US. However, it's basically the same for Canada, and I think I did it the last time in Canada. So we've got a whole slew of experts out there, and the broad range of experts have varying opinions that range anywhere from, and you'll see the headlines today, like minus 20%. Oh my gosh, falling off a cliff. You've seen these headlines, have you not? Yes, anyone? Yes, okay, I see a lot of yeah. And it's scary, and that's both in Canada and the US. So it's a very open conversation on that. And then others are saying, it's actually, they're appreciating and not going to go down. And when one sort of starts, as I like to do, we look at lots of different sources. So looking at all of these different sources and aggregate them and be all geeky, the average is that we are going to appreciate. And then I'm going to share with you specific other experts showcasing various MSAs is what they're called in the US. CMAs are in Canada. It's basically like an area or a city or whatever have you, like a census metropolis area. Same thing in the US, a little bit bigger than a city typically. And most of them are set to appreciate. And I've got the actual data. So it will feel like a softening because confidence matters. And remember, we always look at the net difference. So I've got lots of data on that, Naran. Thank you. We will be touching on it in a moment. And so why I share what my master's degree is sensational news. So this is important because there's a lot of sensational news out there, and that's why I cut through that stuff so that you know what's actually what's actually useful, and that you can navigate this, you can be a leader, you can be the expert, and not get caught up in the fear, not get caught up in the fake news. And that's what we're here to do. So I'm going to get right into it with GDP. So that's not from June 9th, my bad. I thought I had removed that. This is current, as you can see, October 17th. So what we're seeing is that the US is revised. This is just Scotiabank. So we look at lots of different ones in terms of different sources. Scotiabank has revised their US GDP down from 1.8 last month. This is for 2022 forecast for this year. It's gone down to 1.7. It is still growth, just to be really mindful of that. And Canada, Scotiabank actually revised it up from 3.1 to 3.2 in terms of GDP growth. Again, both of these are growth, which means that in 1 year, rents will go up, and in 2 years, property prices will go up, all things being equal. Again, we look at, in the real estate cycle formula, we look at 30 some odd indicators to be able to project and forecast that duration and how long it will be. However, ceteris paribus, they say, all things being equal, if this were the only driver, if this were the only leading indicator of real estate, this is very positive news. This is very positive news. So we want this as if it's absolutely a leading indicator. Now, that said, we've got this in other interesting things out here. We've got this Daily Wealth had an article about, and I almost went on a rant, ladies and gentlemen, on this. However, I am not going to. The Conference Board has a leading economic index. It's called an LEI, and it measures basically it's supposed to signal when a recession is going to occur. Now, there are many signals of a recession, as we know, GDP being negative growth for 2 quarters in a row. The inverted yield curve is often one, though generally it's inaccurate. And so this LEI has 10 economic indicators that they look at in order to discover if there's a recession. And in this case, they found that it is. A recession is nearly inevitable and is certain. However, bear with me. We're going to come back to this in a little bit, because look at the indicators that it includes: manufacturing, unemployment, building permits, credit conditions, stock prices. However, it isn't as robust as I would like. We look at 33, remember? So, okay, it's another one to have on our litmus test. However, we do agree, based on what we've been able to uncover, is that there will be a recession. However, the most important questions are how long and how severe. That's essentially what we're looking for. Yes, things are going to feel a little funky because we have inflation. We have inflation, and as a result, inflation brings the side effects of a recession. That's just where we are, economically speaking. So that said, we want to look a little deeper and find out, okay, we're going to go into a recession. We believe that. How long will it last? And there's a number of really, 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 really good news points, and I'll talk to more of them a little later. Quickly, some of the good news here is that employment rates are crushing it. Canada and the US are still doing very well in terms of job growth. I know, pardon me, let me rephrase that. The US is doing very well in terms of job growth and still is doing well, whereas Canada wasn't doing well, and now it's coming back. There's job growth, positive job growth. So that's really good news. And we also have our new gross output numbers that are for the US that are very helpful. So we'll talk about those as well. Anyway, so I thought that this was an interesting LEI, this LEI trigger date. And so this is also, oh yeah, this was cool. So the other thing about their leading economic index is that in their index research, and this is SansburyResearch.com, it was also the time until the recession, not the duration of the recession in their LEI index, whereas we look at the duration, they look at how long it takes to get there. And so they mentioned based on their data that the trigger date was August 31st, 2022. I would arguably suggest that it was a little bit earlier. And they're in the process of identifying, that time until the recession. So anyway, it was very interesting. The good news is that we're going to dive into it even further with more data. So then the US gross output. So last month we talked about GDP and also a relatively new, less looked at metric, an indicator called gross output. I'll talk to it in a second. And it's generally, it encapsulates way more of the economic activity. And I'll switch over. It increased 1.7% in Q2. It takes a little longer. Oh, Vincent, you're raising your hand. How can I help you?
So I got a question. So I'm listening to this, but I'm also trying to think about the election in 2024 in the States, because interesting enough, you keep saying 2023, 2024, we're going to be, that's where it's going to start coming out. But with election coming, and we know the effects of that as well. And I was looking at the last graph you had, the previous one, and I was looking at 2020, and I was trying to see where the U.S. leading economic indicator was. And it was interesting. It looked like it was on a down. So I was just trying to see with the new election coming up, how that's going to affect it as well. So I'm just trying to keep that on top of my mind, see if it plays a factor there.
Thank you, Vincent. And it is always good to keep politics, because politicians are actual lawmakers, and lawmakers impact everything we have to do with our economy and real estate as well. So those do play. They have different policies and different approaches. And notwithstanding that, these are the at the moment where the economic indicators are, how they get handled, and the new policies that come down the pipeline based on a new potential politician or political party in the lead will make a difference for sure. And it always does. And this is why, ladies and gentlemen, it is incredibly important to vote. I don't care who you vote for, just make sure you have a voice. And I do care actually who you vote for. Choose the right people who are going to help you most with your goals, your real estate goals, your financial goals, if those are what you're needing to. Otherwise, I don't care. All right, so a little bit as a reminder about the gross output. It does it's a more complete picture of economic activity. It lags a little bit more. It's a relatively new metric, so it's not as well known, but it captures 66% of activity, whereas GDP only captures 44%. And I thought that was really interesting, or I should say 66% more of activity. So anyway, the bottom line here is that there's growth, and while it's light, it is still growth, both on GDP and gross output. So gross output, it was the total is up. It's 1.7% up, and 16 out of 22 industry groups contributed to that increase. So what's important about that is 16 out of 22. That means like a good portion, a good breadth of industries are seeing a fluctuation. It's not like all of a sudden there's like no economic diversity, and the only thing that's really holding up the country's economic activity is technology or something. Although Vincent, I'm sure you would love that. But so the U.S. economy, next headline, Washington Post, the U.S. economy likely grew a lot last quarter. Most people didn't notice. This is the kind of headline I like to see, don't you, ladies and gentlemen? So what this is showing is that the headlines are kind of just obfuscating everything and just taking over, and they're just leading with, the most sensational whomever can get kind of that media time. And this article is suggesting that the most recent quarter, so that would be quarter 3, would have risen 2.9% for GDP. That's really good for the US. So then Scotiabank might actually forecast up a little bit. We'll see how it goes for the full year. And something that I'm bolding here, because it's something we've talked about a lot, is in trying to unpack like how deep this recession will go, is that recessions are not typical when unemployment is at record lows, and certainly when job growth is at record highs. So we have both of those conditions right now in the US, and actually now we're starting to come back into it in Canada also. And for now, the economy remains strong by many measures, quote unquote. And I thought it would be nice for you to hear that or read that from somebody other than myself. It's starting to gain traction out there in the news and in the media that, in fact, there's real hope. And so KPMG actually did a study. So I'm not crazy, guys. We're looking at this really smart. They did a study. It's called their 2022 CEO Outlook, and they surveyed 1,300 CEOs of the world's largest businesses. Very cool. And 58% expect that to be, so that's a majority, expect a recession to be mild and short. And 8 out of 10 anticipate a recession over the next 12 months. So again, we just have it. 1,300 CEOs also agree, and so does the Washington Post in this particular article. And what our data is showing is that it looks to be a mild, relatively short recession. And in terms of the duration, looking in sort of that 12-month window. Again, these always change. We'll be on top of all the data, and it's looking really, really positive. And we'll see more of that. So here we are when we plot that on the real estate cycle formula, because we want to be finding out how long it's going to be and how long these are going to take. And again, we're seeing positive. So we're going to experience this softening. It's kind of like a quick contraction period. And we're looking at a long, modest haul for a good expansionary period. So that's where it's hard to even call it a contraction, because we're actually in stabilization period right now, but it's going to be, so we're going to probably skip ahead to this contraction period, very, very soft, very, very short, and then we'll be really quickly into an expansionary period. So that's how it works, because remember that clock, it doesn't just go in a real nice, like, oh, it's 6 months here, or it's 2 months there. It takes its whole time. So jobs. Now, as we move through these are all of the key leading indicators that we always look at every month for your market update. And the September summary for Canada, look at these jobs gains. So remember I was saying June, July, August, it was not looking good. We were concerned for Canada. Something's turned the corner here, up 21,000 jobs in September. Okay, not out of the woods yet. Certainly step in the right direction. Do you agree? Yes, excellent. And unemployment, it started creeping up a little, and we didn't like that. And in September, it has also come down from last month. So these are good. This is why we're looking at these statistics month over month over month, and then back over the year, so that we know exactly where we are and where we're headed. And that way you, as real estate investors or home buyers or joint venture partners, can really, really calm those folks down out there and see that really investing now is actually a really good time. And I'll tell you more about that in a moment. So the participation rate is down just a teeny tiny little bit month over month. Really not concerned about that. The participation rate is right where it needs to be, right on benchmark. And the wages are up month over month, another 5%. So all in all, in the job situation in Canada, we're certainly on the right trend this month. We will be watching the jobs gains. That's important closely, but it's nice to see that positive trend. So for the September summary for the US, look at these jobs. I mean, I have to go back to May. May, jobs, 400,000. June, 372,000. July, 528,000. August, 315,000. September, 263,000 jobs. So yes, the headlines are showing things like, whoa, we're seeing less growth. Oh, there's not enough jobs. Actually, there's still very robust numbers, and cumulatively, this is very good. Yes, we are watching it. That's why you're here. This is why we do this every month. And that's still very healthy job growth. also the unemployment rate is down 0.2% at 3.5%, which is also a historical low. Like, the unemployment situation is declining and it's at a historical low, and jobs are going up. So there is definitely some positive movement here. This shows just a whole bunch of stats for the US in terms of consumer price, and it just shows August versus September. So you can check out the unemployment rate was 3.7. It's now 3.5. That is very good. The employment was 315, now 263. And something that this is only rated on a quarterly basis is productivity. However, I have showed this measure before, and it's really a valuable tool because it helps us understand if there's a lot of jobs out there and the productivity number isn't where it needs to be, and it's improving, by the way, so this is good news. If it were not improving, if it were getting worse, then we'd have a situation of really not necessarily healthy employment. It'd be jobs for the sake of jobs, as opposed to jobs where there's actually economic activity being generated. And since we're seeing an improvement in both jobs and productivity, this is yielding well for us theoretically to have very good GDP, which of course all of these leading indicators support how much rent you get for your properties and the value of your properties in time. That's why we look at these metrics, because they tell us the story a couple of years down the road. So when it comes to jobs, I know this talks about immigration, and we'll talk about immigration in a moment. However, this was very interesting. More Canada jobs for economic immigrants due to a wave of retirement. So as you know, we need to look at not just population growth, we also need to look at demographics. So what's happening? We have an aging workforce in both Canada and the US. So I just want to actually put that out there. I often have these, if it's specific to Canada or specific to US. Today, there's a lot of data and at least conceptual, concepts, I suppose, that apply to both Canada and the US. So we're seeing that the working age population has never been older, and more than 1 in 5 persons is close to retirement, which is an all-time high. So we want to be cautiously optimistic about this because we want to look at things positively where it makes sense. And aging population means that there could be more opportunities for immigrants. So this is an impetus for Canada and the US, who's not meeting their targets as easily, reaching those immigration targets. And that's important for our economy. It's also important for rental housing providers because, of course, people need, and particularly immigrants, need a place to live. This will be a decisive factor in how long Canada's recession will last and how mild and severe it will be. Immigration is key, and this also applies to the US. And I've got some really cool data on immigration and the workforce in just a little moment. Oh, it's coming up, I think, next. All right, so jobs on the balance, very positive. So again, what this does is it pushes upward pressure on rents and on property prices over the long term for quite some time. So people, oh yes, we're not even close to ready for the population growth we're getting, says the National Post. And this was very cool because it actually addresses our problem, real estate investors, where it talks about housing. So it's one thing, great, the targets are there, the borders are open, and whoa, where are they going to live? And this federal conservative leader actually says, as a policy to relax, is recommending that it's primarily cities that are in charge, municipalities that are in charge of zonings. So they are suggesting that if a city wants federal infrastructure funding, they will need to relax zoning laws. So they're bringing money and skin to this game to incentivize. Now, again, this is a conservative leader. It's just a policy, a proposition of a policy. It is not being acted on at this time. However, it's a very courageous and creative concept. So it's good to hear these conversations are happening, and why that's important for us as real estate investors and rental housing providers is we do want densification. We do want more supply. It does help us. And I'll tell you why. So we do say that we want immigration. We need to make sure that we've got a place to live. And this really does strike at that not enough supply. And so how do we get that? And this is a solution. So there will be that upward pressure on rents and property prices for a long time because there really isn't enough supply. However, I think I've got it in the next slide. I'll just say it here just in case. So why do we care as real estate investors if there's more supply? Why would we want that? Pop it in the chat. I mean, wouldn't you think that if it was like super tight demand that we as real estate investors wouldn't want it? Because supply, demand. Why do you think we want more supply? You can unmute yourselves too. I don't mind. Have a conversation. Ah, Hugh! Bingo, bango. Exactly. There's more opportunity. First of all, there's more opportunity for housing individuals to help with our economy, to help with jobs, which also creates prosperity, and prosperity creates good appreciation in real estate. Excellent. It also provides more opportunity for us as real estate investors to actually acquire rental housing providers to acquire properties to be a rental housing provider with. And so it's really, it's a win-win. We want to look at this in terms of abundance rather than scarcity, because the more there is, the more chances that we have to invest, and the more people that we can have in our wonderful country of Canada and support them and being prosperous, and the country as well. So good job. Thanks, Hugh. So some of the population projections for Canada, there's a lot of numbers there. What you need to know is that all of the numbers, so it's over the next 50 years, it's planning to go from 37 million approximately from 2018 to 55 million in 2068. 50 years. Woo, I might be a little old grandma. With a population that almost doubles. Not quite, I get it. So this could be fun. And also the proportion of seniors is going to increase in that time frame. So again, we want to be thinking about it from a couple of things. One is we want immigration, absolutely. And that is going to be happening. That's the primary way that Canada will be increasing its population. And then also more seniors. Okay, think ahead. What types of individuals that you may be wanting to house as your tenant or client profile. So for example, senior housing may be an opportunity to look into, given that more of the population will be then. Now, I'm also a big fan of Brookings. It's in your REWL intelligence report that's sent out today, your weekly report. There's a lot more on this particular study, and the Brookings is a they're really good researchers. So the immigrant workforce supports millions of US jobs. And I was like, how cool is this? They have gone and created a whole new perspective based on a hypothesis and some significant research, and it's called the complementarity index. And it shows that the immigrant workers broadly support and are complementary to native workers. In other words, they don't typically go for the same jobs. So in other words, having more immigrant workers, contrary to popular belief, in terms of, not popular, I should not say that, some people's beliefs that having immigrant workers come into Canada or the US or wherever take jobs from others. And in fact, this study proves that they don't take jobs, they actually provide complementary services that support other jobs and lift the whole. It's like making a bigger darn pie, which is really, really cool. And then I started looking into this data just a little, like not a lot, but check out some of these. So these blue dots here, this is where there's a higher immigrant share of those particular jobs. And then their opportunities on the bottom is the opportunity to future growth. And look at over here on the right, home, health, and personal care aides. And we've got a population that's aging. What a wonderful fit. Like this is where we need to be considering. So not only is that something that not most, but as you can see by the data, it is one of the more higher immigrant share of that particular job, and it's in one of the highest growth. So I think that that's a real cool opportunity. And I think Yeah, it's nice to wrap our heads around this and again be those leaders saying, actually, if someone's saying, oh, immigrants are going to take other people's jobs and all that and be protectionist, this might be another way for you to frame it for them and say, hey, actually, they're gonna, and this study is long, by the way, I'm just giving you like a little bit. It's really in depth of, okay, like even a financial advisor, let's say you want to be a big honcho financial or real estate advisor, it is very common for an immigrant to be an office administrator or a actual financial advisor support. So these kinds of things are really helpful for long term for that argument. So people, we're not quite where we want to be for our population hitting those targets in terms of immigrants, particularly in the US, although we'll get into it probably for the end of the year or probably actually next quarter, because I'd like to see the annual stats. That would probably be better. I might wait till January or so. Okay, interest rates. Are they going up or going down? What do you think? He was like, okay, I don't know. Yeah, all right, that's fair. Okay, I will walk you through this. Yes, so Scotiabank forecast tables for the policy rates on October 17th. We can again expect more, higher, stronger, and faster. Maybe not quite so much faster. We are going to be experiencing more higher interest rates for the policy overnight rates at the Federal Reserve and the Bank of Canada, which then trickles down to mortgages and to other lines of credits and things like this, based on the financiers' rules and regulations. So that's where we are today, and I'll show you a little bit more. So this is where we were for September. You can see the actual dates and the change. So September 7th in Canada, it went up 0.75. You can see the various changes: March 2nd, April, June, July, September 7th. And we are expecting to see more. I'll tell you about that in a moment. And then similarly in the US, you can see that it, as of March, May, started to go up. And so both are up significantly. And then that is translating into higher mortgage rates. This is just a mortgage rate sample from the US. Canada, same thing. We're all in this. We know and I can expect interest rates to increase. So before I go on, interest is tied to inflation. And we know that inflation, which I'm going to talk about next, came from the government, both Canada and the US, printing a lot of money, circulating it in the world here, in the economy, when the economic activity was down. So we saw this inflation coming way before, and we called it for September 2021. You may or may not remember that, however it was. And what we can see is that inflation is a lagging indicator. So it was exactly on schedule. Yay! Which means that it's probably still on schedule. Okay, so that means it's not going anywhere. And I did the math back in January 2022. So yeah, January 26th, 2022 this year. I did the math, and it basically required that we stopped government spending kind of in that way and had our economic activity improve, because that's an important part of it. And it would still take us about 2.5 years for inflation to be materially impacted. Well, fast forward to now, we're in October, and government spending on both sides of the border is still up. I mean, that Inflationary Tax Act or whatever, that's a lot of money the US is doing this with. Canada is no better. And so we've got that as a problem. Our interest rates should have been increased 2 years ago when this all started to occur. So we're behind the 8 ball. And so we can expect interest rates to continue to rise. Now, you might think, okay, is there a silver lining? There's 2 silver linings. And one is, oh, Ron went up to today by 50 basis points. Okay, well, there you go. My point exactly. We're planning on this going up. Now, that might sound scary. There's a couple of things that aren't so scary when it comes to interest rates going up. One is they're still at historical lows. I know that sounds bizarre, and I've shown in our last research lab what those historical rates are. I didn't include them again today. I don't want to continue bringing it. They are historical lows. So we're still at a level where, okay, yeah, people have been able to invest in real estate and make it work in the past at these higher rates. I'm not suggesting that's great. I just want to say some context. Okay. And then the other thing is this may be an opportunity to consider acting more urgently in this softening and acquiring more real estate and acquiring it now and getting in while interest rates are lower. And I think that's all I have to say about interest rates for now. I think when I go through inflation, I may get into a little bit more. Any questions on that? No? Okay.
So Jennifer, if you just want to breathe for a second, give your voice a rest. You know, what's interesting is that today when interest rates went up by 0.5%, the number of calls I got, people calling me going, Naran, you're in real estate, the interest rate went up. I'm like, yes, so? It's funny because for those of us that are in the game, it's kind of like saying, oh, look, the sun came up today. Oh, it's raining. Big deal. Get on with it, right? It doesn't move us because we know that this is happening. We know we predicted this a while back, and we know it'll continue to climb.
Thank you, Naran. You reminded me of exactly what I needed. I wanted to add to this. Thank you, thank you, thank you. Perfect. Yes, exactly. The other beautiful slide that I'm going to show in a little while is about the amount of equity on average that I think it's an American stat, the average home has generated in a fairly short amount of time. And it's to a tune of like $320,000. So if people needed to, they could find themselves in a position to probably extract some equity and therefore buy themselves a little buffer while interest rates are going up, assuming that they've got variable and they haven't locked in and things like this. So again, not to dismiss it, household budgets and all of that, that's very important. At the same time, there's been a lot of wealth created. And I'm going to show you some darn headlines that are trying to freak you out that that's not happening. However, the data behind it supports it. So thanks, Ren. So this one is from Stansberry Research. Macro forces are conspiring against you. Here's what you should do about it. And what I love about this is that Stansberry does an excellent job for the most part, I would say. Like I'm 99.9% with them on the inflation situation. I feel like there was just one comment once. It's good. So they understand increase in the supply of money and credit. They understand how it comes. And so I really do recommend that this is a good read. It is in your intelligence report because it will show you what, if you're not understanding inflation yet, that's okay. And it's a great article in your newsletter, in your intelligence report today. So again, in brief, inflation is here. It's here to stay. We know why. I told you about the printing of money. And what for investors, what we need to know is because inflation is here to stay, higher interest rates are also here to stay because that is one of, there's only like basically two and a half solutions to inflation. One is the government stops spending money. Has a budget, sticks to it, doesn't spend that extra money, increases interest rates. And then that's and a half is innovation. Innovation can be a powerful, powerful tool against inflation. Now for real estate investors, and I'm going to conclude with this again today, as I have been for some time, is that real estate typically outperforms inflation. And at minimum, it rises with the inflation rate, and you get a little bit of your local appreciation. So what you need to do now is ensure you've got your capital reserves, manage the cash flow, and buy during this softening and hold for the long term. And there's going to be more on this in a minute. We've got more to talk about that. I really hope that that's communicating it. And I really hope that for those of you who are looking to source and raising capital and sourcing investors and whatnot, that this is useful to you in your conversations and calming others down to go, this, regardless of the headlines, regardless of the news, regardless of what all those thousands of experts are saying of like all these different things, this is now time to really to go for the long haul and to get in. So the CPI index, I think the most important thing is it's up. Well, it's okay. It's technically down a little bit in Canada. My bad. But you can see the previous inflation rates. So they're, went up to June 8.1, July 7.6, August 7, 6.9. So we'll see how that goes. I don't really put a lot of credence in the CPI because it doesn't include the things that are most important to us, like food and shelter and rent and gas. So there you are. But it is what it is. And oh my gosh. Okay. I was gonna go on a major rant with this, but I think I just will leave it to the to the intelligence report. What the heck is this all about? Seriously, so this is StatsCan and the Bureau of Economic, I forget the word, economic whatever it is, the comparable in the US. They expected it to come down. Like at what point did they expect inflation to really, really, really fall? We're not there yet. We're not even close to there yet. So a 0.1%, no way, man. So not that it necessarily is going to be like shooting crazy rising. However, it's not going to come down significantly for a little while. So just be mindful of that. And that means that it's a good time to hold on to real estate. So when it comes to the rental market, to buy or rent, this is just an interesting article. It's important to us, Hugh, and everyone because of opportunity. I'm picking on Hugh because he's got his camera on so I can see his reactions. So there we go. Yeah, exactly. It's awesome. So what this talks about is, I'm just going to switch ahead. Most important thing that I want to call your attention to, and this is by StatsCan, is home ownership is down, renting is up. And that means that for rental housing providers, there is and will be even more demand for your products and services as a rental housing provider. So that's a whole bunch of data in there if you want it and you need it. And you've got the link in your intelligence report. However, that's what you got to get and glean from that one. So now when it comes to the 2022 rent reports, everything in Canada is basically up year over year. So, okay, there we are. Here's the rentals.ca report. You can see Vancouver's still leading Toronto. This is October versus September. I know you can't see that there, but it is September. So the couple of orders of ranking have changed, but not much. And remember, folks, I know most of you might be like, what? Why is Jen talking about Burnaby? I was one of the first people to talk about Burnaby and one of the first to identify it as a top market to invest in Canada. And it has consistently been in the top 10 for rents oh my gosh, probably for years now, but at minimum in the last year and a half. So this is good. Again, rents are lagging indicators, so not much to do here other than what you want to also be considering when you are looking at your market. You do want to look at your market. It's great to see these year over year stats. That's awesome. When you also want to be looking at month over month. Month over month is where you can identify, oh, what's happening at a micro level in my community, in my city. What do I need to do? Do I need to change something? You might not necessarily need to change it right away. You need to be aware of it because it'll allow you to be nimble if all of a sudden you get a vacancy. So you'll want to pay attention to that. And then the same thing, a rent report for the US, very similarly. So August was up 12.3% year over year, and September is up 8.8%. And it's interesting. So this headline was fine because it's just a monthly look at rent price trends across the United States. However, it's interesting because some of these headlines are like, oh, it's not growing. Rents aren't up. They're soft. They're stabilizing. They're almost down. Well, no, they're not almost down. They're up. 8.8% is up. So not up as high. And that's that distinguishing factor that kind of keep catching us over. So these are a couple of interesting stats in terms of in the US, the number of markets, the percentage of markets that were up year over year in September 2021 versus 2022, 89, let's round up, okay? 89% of markets in the US had their rents up meaning that 11% had their markets go down in terms of rents. That's a very significant proportion of like 90% up. Because again, we're talking all of the markets in the US. And then month over month for August, September versus August this year. Okay, so now we've got a little bit of a softening. You can see that 61% of the markets were down. But remember, when they communicate down, it's down from their previous increase. So for example, 12.3% versus 8.8%. So it's down from the increase. It may not be down overall. I think that's important. You do need to go and look into that specifically. Like I kind of showed you over here, you want to know that in your month to month for your market, you'll need to do that for your market. And here is a great example of diving in deeper. So Florida, as you know, we've done a lot of market analysis on Florida, and it's been up 25.5% year over year. And that's consistent with what we're seeing in other sources as well. So there you go. So those are some of the top performers for the US. What it means, as I mentioned, rents are lagging indicators. And so they follow about a year after GDP, population, and jobs, and those other leading indicators. So they're right on schedule. We're expecting them to stabilize for 2023 and 2024 because GDP is, for the most part, like pretty okay. It's a little soft in the US for a couple of couple quarters, and so there shouldn't be a huge major shift. And beyond that, we expect rents to rise for the foreseeable future. And please, again, as always, look into your specific market. That's important. So then, we'll get into a couple of sensational news headlines in a moment. The most splendid housing bubbles in Canada. House prices plunge. Canadian housing bubbles often ranked among the top, but CPI spiked and spreading into economy. Prices continue to plunge. Are you afraid yet? I'll go on. So doom and gloom, there's freaky headlines everywhere. And this is where we always look at that net, the delta, and I'll show you some specific stats in a moment. Again, relating to the US because I've already shown the Canadian ones in previous ones and I don't want to repeat myself as much. But what we saw is that there was an average of about like a 43% increase or 50% increase depending on which source. So let's just go with 50% over the last 2 years for Canadian real estate. And yes, you've got to go into your own market. So some of these plunges are saying that it's gone down 18% or whatever have you. If you actually, when you actually go through, and we have done this for you, go through the math, we're ahead. We will be ahead, even by the end of 2024, as these prices continue to plunge, we should still materially be above where we were prior to going into these lockdowns. So the net gain is, so as long as you didn't, I mean, if you bought it at the high, that's going to suck. You know, it absolutely will, and that's okay. It just means we get creative with our tactics on how to improve the property. We hold it for a long time because it's going to recover. So again, and I'm going to show you some slides on that. So Canadian households have lost billions in real estate cool down. Oh my gosh. I just read another article about this today and I nearly lost it. I didn't include it. I might, this will give you the gist. So this is all over. Thank you, CBC. So home prices are a great contributor to Canadian GDP. The net worth of household, which is very true, net worth of households fell by 990 billion April to June. The crash, the plunging, your net worth is wiped out, 990 billion. What it doesn't tell you is that, so this is other article showed, and I apologize, I don't have the actual number, it's up something like trillions of dollars. So yeah, 990 billion, like I said, I don't have 990 billion, that's a lot of money. So I'm not scoffing at that. However, the gains were trillions. So there's still lots of equity and lots of net worth that are still like being protected within that housing market. Oh, I remember I wanted to tell you something else about interest rates. So another thing that's also going to protect Canadian home prices and the US as well is that, but in particular Canada, because so much of our GDP is tied to the housing market, the Canadian government, who needs our GDP to be at a certain level, this is important, otherwise we won't be a developing country in the G7, we'll be something else. they need to protect that. So they won't go to a certain point with the interest rates, I don't think, and I could be wrong, we'll pay attention, because it'll impact too many Canadians, and they're going to try and watch that threshold, I think, carefully as well. And then the other thing is they have so much debt that they, being us, by the way, we own that debt. We're Canadian citizens or US citizens, as the case may be, and we're the owners of that debt, and they don't want to bankrupt the country, hopefully, by increasing interest rates too much, because that applies to them. So about this, this particular article about, you know, losing billions, it's just that it's like, it's really myopic. It's really so, and here's what they say, quote unquote, the streak of gains in real estate that began in late 2018 was halted by a housing market grappling with rapidly rising interest rates. Are you freaking kidding me, guys? You know better. We look at 33 different indicators, and no, this is not, it doesn't have anything. Of course, interest rates have an impact. This was from printing money, locking down the world. This is like, do you say this? Because it is wrong. We've got to look at the bigger picture. So don't get caught in it. Thank you, Vincent. Exactly. It's not about these headlines. So the interest rates did not cause this. The government response to the COVID-19 situation did, that printing money, et cetera, et cetera. So just being mindful of that. This one was from Finbold. And here, this is also where we get into market confidence. But remember, those 1,300 CEOs of some of the world's biggest businesses said, hey, we think it's going to be a mild and short recession. I really like business confidence surveys. I find, and small businesses as well, because I feel that they've got a really good look on things. I've been paying a lot more attention to them so that I can share that with you. So this is what I do not recommend doing at home, is Google searches. So the top Google searches are showing, of course, do Google searches, but not for this. They're sentiment Google searches. So what they're saying is that the now a third worrying Google trend emerged. Real estate market crash was searched 284% more in the US this September. That's no fun. However, love the masses, got it, understood, and it's out there, and we want to be looking at business sentiment for the most part. However, market sentiment is where we're at. So this is where you, Real Estate Wealth Lab members, our community, get to show up as leaders, because what you're seeing here is there's confusion and this panic and this 284% increase in, oh my goodness, is the real estate market going to crash? Don't follow that crowd, lead that crowd. Help reduce the panic. This is really, really important in this period of noise and confusion. And it is actually more confusing than I think most times. I know we often talk about confusing market. This is a really tough one for people to wrap their heads around. And it's scary, you know, it's had a lot of other factors on it. So I urge you to not follow that crowd. If you're considering Googling real estate market crash, is it going to happen? Please call me. just give me a call. Give Naran a call. Give Vincent a call. Give Ken a call. We got you. Absolutely rely on us. Because again, there's freaky headlines. I'm not even going to go through them all. You can see, I mean, it's just everywhere. There's only US cities where average Americans can afford a starter home. US home prices could fall as much as 20% next year. US housing free fall. Whether it's Canada or the US, you know, it's just, it's a wild ride right there. And this is a little bit of a supply and demand chart that I wanted to show. There are more active listings. That could be for all kinds of different reasons. You know, people are waiting on the sidelines. People are nervous. People are concerned about those interest rates. They're talking more average retail purchasers, not in sophisticated investors such as yourselves. However, back to what Hugh wrote in here, more opportunity for us. This is this moment where there's more active listings and there are fewer showings. Y'all, those massive bidding wars that I know Naran was really struggling through in KWC in the area last year, here's a little breathing room. Time to acquire. This is an opportunity right now to take advantage of these kinds of opportunities. So then in the US market summary, look at this, the median list price is still up 14% year over year. Days on market is going up, active listings is going up. That means you have opportunity. So that's good. This was an interesting one. This is what I was talking about like some of the major forecasters, if you will, of real estate prices in the US. So Zelman, Fannie Mae, Freddie Mac, this is what they were projecting for their various forecasts for next year. And the average of those is a 1.8% increase. So the average forecast for most of them is up, and this applies from what I have looked at in Canada also. It's very similar. So we're not, again, remember I said, this is what I mean, Moran, when I say a softening. That's still up. That's still appreciation. It's not depreciation. Only one of these organizations, which is like the majors in the US, is considering a depreciating scenario. Rightly or wrongly, however, now this is where I think it gets really interesting. This is from Zillow. They did an appreciation depreciation forecast, and look at this. So they're actually forecasting, this is for the US again, so 618 of MSAs are expected to appreciate, just like I would have said on the last slide there. And in terms of depreciation, look at this, only 30 of all MSAs, so like the, I forget the term, but it's like the municipal service area probably, or something along those lines, like it's a kind of the size of a city-ish, a little bit bigger. Only 30 are to depreciate more than 3%. So we're not talking falling off a cliff. It's really like, whew. So we want to make sure that we're looking into, of course, our various markets. However, this is pretty solid. So, and then this is in the US, however, and the number came through as I was mentioning. It's trillions in Canada as well, by the way. This is the national homeowner equity year over year change. In the US, it went up 27.8% for home equity, homeowner equity, as in you're a real estate investor and you've got properties and your equity for primarily has gone up at least 30%. But sorry, I should say 27.8%, was rounding up, to about 3.6 total. Check this out. I'm hoping that these are really helpful, because if you're wanting to add, you know, if people are coming to you and they're like, well, why should I do real estate? Back to what Moran's question is, and like, why would I consider this late in the game? I think it's really, really powerful. Check out these numbers of, you know, the average equity gain. So I was kind of showing up as like the national, like this slide, national year over year change. This is the Q2 2022 year over year change by state. I will just put it out there, ladies and gentlemen, because I really, really want you all to come and hang out with me in Hawaii. Just putting it out there for vacation rentals and doing an amazing, profitable business that's super fun. Is Hawaii had one of the highest gains at 130,000 in equity. So I just, you know, putting that out there. At any rate, you can see that this is where that's broken down, and there's some really great gains, you know. And even if it doesn't gain necessarily insufficient data, oh, those are insufficient data. Okay, so 27,000 in terms of in terms of average equity gain. That's cool. Who wants to say no to that? Nobody. Tell your people, this is why we want to invest in real estate. This is how you can protect yourself in the future. And this, Naran, is where you get really excited for the individuals who are maybe like coming into it late. So even if that doesn't, like, oh, you know, it's still too risky or whatever, then fine. The average since 1991 is up 290%. And this is how equity, it's like, this is how equity works. And many of you have heard me speak of real estate as sort of a 5-course meal, where you get appreciation, you get cash flow, and you get, you know, forced value add, and you get all these different things. And the main course, the absolute main course that is completely unsexy, that nobody talks about, is the equity in terms of mortgage equity, where your tenants are paying your mortgage. This is if you're in this for a long-term play, there's huge rewards available for real estate investors. And we need to keep our sanity hats on, hug each other, not get wrapped up in these headlines, so that we can weather these storms together for sure. So Naren, I hope that helps provide some, yeah, perfect, excellent, thank you. Another one, so we've been talking about this here at the Real Estate Wealth Lab since inception, since the very beginning. You saw that slide. I said, hey, it's going to be increasing for the next decade. Guess what? I am not alone. You're not alone. The Spinbold report was saying single family housing demand will remain solid for the next decade. Demand, and I agree. So yes, we agree at REWL because we look at the data. Demand for new single family construction will be solid over the next decade, meaning land and lot investment at the end of the current cyclical downturn will prove to be strategically valuable. Does that sound good or good? Good, excellent. Okay, so now we know what we're focusing on here. Whether it's single family or not, it's real estate, you're gonna be fine. The conclusions, I think, from today is a validation of a real estate cycle formula. We can expect that long, modest, expansionary period of real estate for a decade after we go through this mild contraction through 23, 24. And it really will depend, again, on that length of recession. And just remember that things, they lag and they lead, and they lag and they lead, and they lag and they lead, and then they impact each other. And so it is going to feel funky. However, we're navigating this together, and you're going to see these crashing. This slide has been up, I think, for almost since last year. We're expecting these crashing real estate headlines. Don't worry, we've got lots of things that are supporting it, floating and buoying the real estate in terms of lack of supply, inflation, expanding population, and other indicators that are pushing it up. So in 2 more slides, lean on us. REWL's got you. We've all got you. The real estate market is indeed shifting. It is confusing, and we can absolutely help you navigate this time and this confusion. And you and your partners and your families and your friends want to make informed, confident, timely decisions in your market, and you can lean on us to do that, your trusted real estate professionals. So ladies and gentlemen, here's what you do and you don't do. Buying and holding is a good thing long-term. Thank you, Olu, appreciate it. And then I do want to caution you on rent to own and fix and flip right now. There's these macroeconomic factors. It's not a good time. This is where we're going into sort of a contraction phase really, really kind of quickly. However, for the long-term buy and hold, you're going to be in good stead to take advantage of this right now. All right, so that's what you do and don't do. Thank you very much. And thank you, Olu.
Thank you so much, Jennifer. Before we move on, hey, gang, I have an idea. What I find is that we get a lot of information coming at us. And Jennifer, you mentioned about the amount of fear that was out there. I can't remember your exact wording. You showed a slide and you talked about how we could, how we need to show up as leaders. Mm-hmm. You know, when there's fear in the land, then money starts looking for safety. People look for safety, and money looks for safety. And you get to show up as a person that can provide safety for people. And when you do that, you start to elevate yourself above the crowd. You start to attract joint venture capital. A number of you have asked me, how do I raise joint venture capital? Be real, be authentic, but at the same time, show up as the person who's got it. Like it's you know what you know, and ask yourself, what does this mean? Because what happens in the general culture, in the media, is they will bombard us with just surface level statements, and then leave it, put a negative spin on it so that it becomes something meaningful that is negative in our lives. But we get to create that. We get to look at it and go, okay, what is really going on? What does this mean for my real estate? And you get to provide safety. So here's my challenge to you. Try something completely different. Those of you who are just starting and wanting to raise capital, you need to show up as an expert. Take the what you have learned today and just take one slide and just go onto social media and just do something like, hey, Real Estate Wealth Lab, Jennifer just said this. So this is what I'm excited about. Just one statement. And by making that statement, what happens is a couple things happen. One, you show up as an expert in your world. But more importantly, you get to capsulate what you have learned and crystallize it for yourself. And when you do that, your confidence goes up. When your confidence goes up, you stand tall and you start showing up for yourself as an expert, and people start taking notice. If ever in this world and in our times, if we ever needed financial leadership and leadership for just keeping having common sense in times like this is your time. So don't waste what you have learned here. Don't waste the pain that people are going through. Leverage it. Show up as a person who can bring safety. Anyway, that's all I got. Jennifer Hunt, you are back on for let's go to wherever in the world you're taking us next.
All right, where in the world is Carmen Sandiego? So we're going to go to Burnaby, British Columbia. And thank you, Narayan. That's such a great suggestion, everyone, of taking something and posting it. You don't even have to do the work. We've already done all the work for you, and you get to look like a superstar. And that's what the intention of this is to help you be those leaders. Thanks, Narayan.
Oh, and when you do post it, tag us. We'll share it again. Okay?
Yeah. Thank you. And like it, all that stuff. Awesome. Okay. All right. Let's get this. So market analysis, Burnaby, British Columbia. Okay. Yeah. So this is what we've covered so far. Toronto, Calgary, Vancouver, Honolulu, Maui. You can read. All right. A lot. And we're just getting started. And it's quite likely that our next market analysis is going to be Leduc, Alberta, recommended by and asked for by one of our delightful members, Tara Flynn, and I'm a big fan of Leduc. So that's near Edmonton for those of you who don't know. And yeah, that might be a next. So stay tuned for that for our next research lab. So again, we've been through the real estate cycle formula. We tell you we've got all these 30 indicators are weighted, and they really help us identify where we're going. And then we can plot it and like where we are right now. And Burnaby is showing actually very, very strong signs of where it is. I'll get to that at the end. So, and as Narayan had mentioned at the beginning of this, if you know Burnaby is not your jam, no problem. But please follow the bouncing ball of the GDP, the jobs, the population, and you'll start to see where you can get these sources and how it works. And what are you doing, a thumbs up or you're doing a thumbs down or whatever have you. So real GDP growth. Where am I here? Canada. So Canada, this one is showing that it's down a little bit, you know, from where it was. However, it's up. And this is good news because I did some very quick math of just sort of the averages since the downturn and what's occurred. And we're actually, again, we're looking at the net, and the net since the downturn back there in the negative 0.6, the lockdowns with the government restrictions, we're up 0.8 overall. So this is good, you know, at least it's moving in the right direction. There's some economies right now globally that are not. So that was the net. Now, where are we today? So Canada is for 2021 GDP, I should say. Canada was 4.8. British Columbia was 6.2. Okay, now Burnaby is located in British Columbia. It's in Metro Vancouver for those of you who don't know. I forgot to put a map in. My bad. So Vancouver, downtown, and Burnaby is the adjacent city next to actual Vancouver proper, and it is the most centrally located of the cities in Metro Vancouver, with access to all of the other metros. So that's a it's very strategically located. We don't have Burnaby GDP right here. That's okay. I'll show you how we get there. This is the bouncing ball. So then we look at 2022 forecast, real GDP. So Canada, yeah, it's been downgraded a little bit. This is RBC economics. Notice how it's different than the Scotiabank forecast. Scotiabank's was what, 3.7? This is one of the things I love most about this is I actually have a spreadsheet, and I do put in, you know, CIBCs and Scotiabanks and Central One and TD and all these different economic kind of forecasts. And over time, one can really see who's optimistic, who's realistic, who's pessimistic, by who I mean which organization. And you really do need to take it all with a grain of salt. So we do, and so this is generally speaking what we're seeing, and we put it all together. However, according to RBC, so Canada 4.3, British Columbia 4.2. So that's okay. In 2021, you'll see that BC was better than Canada. We want that. You want your state or your province to be better than the national. So in 2022, British Columbia is forecasted to be slightly less than Canada. Now, I will tell you why that is, and I repeat it later. British Columbia had some floods to deal with, some forest fires to deal with, and they've got a couple of other reasons that has apparently impacted their economic activity. Stay tuned. So that's so what we want to be watching for next year. Now, when we look at British Columbia in and of itself, so last year was at 6.2 and real GDP growth of 4.2. We're still, like, although there's a difference, it's not as high as it was last year. We're still having that, the total movement is in the right direction. So that's good news. I don't think that should be necessarily a negative too, because that's actually, we're doing all right. So now though, Yahoo Finance is saying that Ontario, BC, and Quebec are likely to be squeezed the most when it comes to the economy weakening, and that was according to CIBC. One of the reasons why that they're saying that they have the strongest headwinds in 23 and 24 is because of the higher household debt, the higher real estate costs, therefore the higher real estate downturns could impact them, tight labor conditions, and that's going to strain their growth. I'm not so sure. Because the other thing about Ontario, BC, and Quebec is that they have the highest immigrant population, and people drive all of that activity. People are I'm GDP, jobs, population trumps every freaking time. So we want to be looking at population, and that's why we weight them. And I can't wait to get to that section. just you wait. Okay, so recession is not guaranteed. BC braces for a bumpy ride. Yeah, okay, so a bumpy ride, that's all right. This is business in Vancouver. And they're saying, so the labor market is facing severe crunch. However, just wait for it. Inflation is sky high. We know all this. And that real estate sales are down in August. We also know that. So, I mean, this doesn't really tell us a whole lot. It's just, again, what we're seeing those headlines of, you know, what's going on in British Columbia and bumpy rides and all this stuff. So don't let that totally fool you. Let's look at the data. So growth is expected in BC in 2022. This is important, and in fact, quite a bit of growth, really, like 4%. So it's lower than by 2% than last year, and it is affected by the forest fires and the flooding. And so, however, the BC economy is showing some pretty significant resilience amid these challenges. Another thing that you need to know about is that Burnaby is, Can you hear me okay? There we go. Yeah, okay, great. Thank you. Gave me a little notice that my microphone changed. So Burnaby is located adjacent to Vancouver, as I mentioned. Vancouver is the largest port in Canada. the largest by size, volume, dollar signs through and through. It includes Vancouver, Port of Vancouver, includes terminals in North Vancouver, in Burnaby, in Delta, and in some of the neighboring cities. And Burnaby is one of them with a significant number of terminals in it. Why does this matter? Really good paying jobs that are not going anywhere. Like at all. So again, we want to look at their economic diversity, and there's a significant amount. So now when it comes to Burnaby, there really isn't a lot of good GDP data available right away. So that's okay. Smart. It's called proxies. So when data doesn't exist, it's called proxy time. This is an internationally known standard of way of devising information or data when it doesn't readily exist, and it serves in place of that direct, like directly relevant data if you could get it. So it's closely correlated. It's not the exact number, and it's going to give us a sense. And so when looking at what's going on in Burnaby, okay, consumer spending is definitely increasing. Business spending is hugely increasing. There's an incredible amount of new restaurants, new developments, oh my gosh, so much. Government spending is increasing with new infrastructure and all kinds of different things going on there, and also community planning for density. Is there growing demand for investment? Absolutely. Are exports increasing? Yes. And are imports decreasing? Wasn't sure on that one, so I just put it as a negative. I don't know the answer to that. However, we've got some good ones. And then our business profits increasing, and absolutely they're increasing. So when you get a net result of that, it's a approximate correlation to your GDP value, and the GDP should therefore also be rising. So we can see it as a positive move. And given what we saw for British Columbia's GDP, we would extrapolate that British Columbia or Burnaby would also increase. So that's how we get to that. Jobs are GDP is increasing. Jobs are looking very, very good. This is for British Columbia. The labor force is up. That's excellent. Employment is up. Unemployment is down. Unemployment rate is down. These are all very, very good. So no qualms there. Now, again, not as easy to get that city level data, but again, we can extrapolate based on geography. It's not like we're looking either, like this is at the heart and center of Metro Vancouver. So I would not say, oh, just extrapolate this if it were, some other city in British Columbia, for example, like Chetwynd. Love you, Chetwynd up north. Love you. Very different, and you'll see this in just a moment. So, someone's got something in the chat here. Oh, thanks, Doug. Have a great night. So then for the unemployment rate, again, it's improving continuously. July, well, not continuously, pardon me. Same-ish for July and August, and then September improves. So these are good. These are really good statistics showing the right path. And then, so we didn't have that unemployment data available for and job growth available for Burnaby. However, we got some data, and that is the median household income. And again, we're always comparing it to our state or our province and the nation. And with the city of Burnaby, it's not as high as the province of British Columbia. So that's not as favorable. However, it is higher than the nation, and that's important. And British Columbia, and in particular Metro Vancouver, are highly attractive to immigrants. And we're going to show that in just a moment. So let's talk about people. Okay, so remember, these are weighted. So GDP is important. It's a lever. It's an important one. Jobs is important, and people is the most important, because people create prosperity. People create the economic activity, the jobs, and not most importantly, and importantly, encompassing in that, they need a place to live. Unlike babies that take at least 18 years to need their own property. So this is instant hit, right? Oh my word, look at this. Burnaby's population growth rate. So Canada was at 0.7, BC was at 1.8, and Burnaby came in at 7.03. That's a lot of people moving to Burnaby. Wow. By Canadian standards, I don't know. I honestly, I can't recall at this time seeing a number that not quite. I have seen it that high, just not very regularly. This is a major green flag. That's why I put it in there. So it's attracting a lot of people, and we need to be thinking about that and what that would do to the property prices down the road, and also to demand for rents. So again, this just shows the growth rates and things and the totals. This is huge. This is absolutely huge. So that's a big win. Buy signal. So inflation, again, it's really your call if you think that inflation is going to be helpful or a hindrance to you. It will mean that it's more quote unquote expensive, or your dollar doesn't go as far. However, if inflation is higher, guess what else happens? Your appreciation is going to be higher. So these are things to consider. So British Columbia is at 7.3 and Canada is at 6.9. The rental market for Burnaby, this is really cool. The Burnaby rental market, like look at these year-over-year prices. And as I mentioned in the macroeconomic section, remember Burnaby's been number 3 top ranking most expensive. It's like Vancouver, Burnaby, and Toronto for a long time, and increasing their rents. So Burnaby is ranked as the 3rd most expensive city in Canada for September, and has been for some time in various orders, but there. I think it's funny, you know, of course, like look at this, 30%, 38%. Guess what I have? I have 2 3-bedrooms. So only 8% for the median price, which is fun. I'm just teasing. Well, I'm not teasing. It's kind of funny. Burnaby is the second only. Oh, look at this. So the rents in British Columbia, 31.2%. So again, you know, with your 4-bedroom and your 1-bedroom, Burnaby is definitely way up there for rents. And second only to Vancouver in terms of percentage increase. So you can see here in terms of the month over month. This is from this rentals.ca. So it went month over month was 0.6 for Vancouver, and 6.3 for Toronto, and 6.8 for Burnaby. I just see a question here. Ron, would you grade the adjacent New Westminster and Tri-Cities into the same forecast? Oh, I love your question, Ron. No, not quite. Certainly positive, absolutely. New Westminster does not have, I'm going to go back. New Westminster does not have this, and neither does the Tri-Cities, not this level of population growth rate. And they don't have the level of infrastructure that's being developed right now. And that's in particular, Ron, you'll be familiar with, it sounds like you know the area a little bit, you'll be familiar with some developments like the Lougheed Mall development, the Brentwood Mall, quote unquote, development, and Metrotown. And there's like, I can't remember the number of high-rise condo buildings that are coming on. And it's upwards of like, I don't want to overstate it, but like 100,000 or hundreds of thousands of units that are being built right at SkyTrain accesses that are like minutes from downtown. It's going to be a very, very, very booming city, and their Department of Planning has been quite, and I yes, New Westminster has also done some things like this. However, they don't have the same level of projects, and obviously Coquitlam did too, and they did great. However, they don't have any new ones on the horizon. I actually owned in that Coquitlam one, so I hope that helps, Ron. So we can go into those in more detail. It certainly wouldn't be bad, and some of the stuff doesn't apply. Burnaby. Okay, where am I? Oh, vacancy. Great. Yeah. So the vacancy rate. This is from 2011 to 2021. So this is not necessarily like these are the top 5 cities with the biggest increases in vacancy rates. We do not like that number. That's not great. So don't like that. However, in 2021, BC's residential vacancy rate was 1.4. So low, way low by comparison. This is why So you'd think that like if all those people moving in and da 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 da, how could this happen? Because they have an incredible amount of supply and development of brand new builds coming on. So like it just depends on when did that condo get done? When did that condo get done? And then all of a sudden it's like, oh yeah, there's a massive vacancy rate. So again, knowing your community and digging in a little deeper, that might freak me out, except I also know that Port Moody had a lot of supply coming on. Burnaby had a lot of supply coming on. Langley's had a decent amount of, not a decent, pardon me. Langley has had a tremendous amount of supply. And all of those communities, I know a little bit less about Richmond, all of those communities are growing significantly. So again, we need to be so mindful of how data is like really give some context, you know? Okay, so then vacancy rate. So Canada's 3.1, province of British Columbia 1.4, and Burnaby 1.7. So this is a little less favorable than the province. Not ideal, however, it is better than the nation. So that is good news. And the good news is also that vacancy rates are slightly higher than BC. Sorry, yeah, that's wrong. Anyways, you got the point. It's doing okay. By the way, when it comes to vacancies, like a 1.7% vacancy rate is like basically like right. I mean, it's basically like there is no vacancy rate. Okay, so just be mindful of that too. I think a benchmark vacancy rate, like more broadly speaking, is like sort of like the 5%, something along those lines. So we have a tight vacancy situation. And when it comes to the property market, this is your property market summarized based on the various changes. So sales are down, as in most places right now. Listings are also down, and the benchmark price is still up year over year, but it is down a month over month change. Now, this is a fun thing that you'll also start seeing in the news, just broadly, and I've seen it already, and just be mindful of it. Now we're in the season, so we start having seasonally adjusted stuff, because in the fall there's like a late sort of early fall, there's a bit of a people typically will go into the market by September, October, and then we come into the later fall and we see less activity there in of itself. So we also need to take that into consideration as to what's going on, because it's just not a great time to sell. But overall, appreciation. So it's not like massive year over year change. However, it's slowly going and doing its thing, and that does not include inflation. And again, I think that a big reason for that is because of the massive amount of supply. Like there's just been so much that's been coming onto the market, so that will get absorbed, and it will be for the long term. Highly recommend that. So when we put all that together, Burnaby's actually at the very, very end of stabilization, and it's the beginning of expansion. Now, again, we don't know how long this is going to last or whatever have you, because these things can change on a dime, and we may find ourselves into that contraction stage very, very quickly. But it is poised, again, just that softening that we've been talking about, because we are looking at a long-term modest increase for a decade after we get through this. So do's and don'ts, again, this is really about buying and holding right now. I meant to remove that yellow flag, but I guess just apply that to the caution side there. So buy and hold is really the best tactic to use right now. Rent to owns and fix and flips can be, and BRRRRs, whatever you want to call them, just a little bit more concerning at this time. However, as I mentioned earlier, it's better to get in. It's not timing the market. It's about the market. So getting in and being a part of that. So, ladies and gentlemen, my conclusion today is that over the long term, home prices have nowhere to go but up. On top of supply demand issues and inflation and other indicators, we really are poised to put more upward pressure on real estate over the long term. So almost anywhere, it's buy and hold. And that's big, like caveat, disclaimer, do your diligence. However, there's a real lot of opportunity. And I'll leave you with the final thought. Again, as a reminder, is what you need to know is inflation is here for a lot longer than most are letting on, including the they who expected it to decrease that I talked about earlier. And that is in and of itself is a buy and hold signal, because real estate is one of the most stable assets during inflationary times and turbulent times, and we have both. So those are both double buy signals, if you will. Of course, making sure that you've got positive cash flow and great resources around you. And thank you very much for your time and consideration. Really appreciate it. Stop sharing my screen.
That's awesome, Jennifer. Thank you. Great presentation, and I'm sure that half our group is right now booking flights to Burnaby.
Right on.
So I just want to pause for about 5 minutes. And is there any questions or comments that you might have? You can throw it in the chat, or you can just come on and have a quick chat, ask it live. I really like that, you know, here's a question for you, Jennifer, and it's a question that I have. Okay. Given that interest rates are continuing to climb, and given that we're going to see a softening into 2024, I have a property right now that I'm in the process of refinancing, and I'm duplexing it. So I need to know, should I take just an open mortgage at a higher interest rate for 6 months and then refinance when I've gotten double the amount of rent? Or should I lock in right now for about a 2-year term? What do you think? Let's argue this out.
I like this. It depends on how much do you think it's going to go up in value based on your ARV with the new suite.
Oh, yeah, that's a good point, right?
Yeah,
how much? It will go up in value by about 200,000.
Yeah. So then, do you want to extract that ARV or not? Really, that equity? I think I would take, based on the goals that I believe I understand you to have to continue to grow.
Yes.
See, this is why we always ask what people want to achieve.
Yeah.
That's where it starts. That you would probably want to do the open variable now, then do your magic, do it fast, furious, and successfully and efficiently, as you always do, Naren, and then pull it out, and then maybe you consider locking in.
Yeah. No, that's exactly my plan. I just told my broker today that I needed 24 hours to crunch the numbers. So
and then
the numbers speak for itself.
That's great. Congratulations.
Oh, well, thank you. What else is going on in our group? Anybody have any questions? I didn't check the chat. Let me just have a look. Would you grade the...
Allie, I see your smiling face. Wonderful. I saw you there.
Allie's coming on.
Yeah. What do you got? What do you got?
Another great session, really great insights. Do you think Alberta is like in a little bit of different situation than rest of Canada when it comes to recession and whatnot?
Yes.
The intel I'm getting from there is like their people, and Vincent, you're there, I know, saying like they're probably gonna avoid the recession altogether because of like their economy and where things are and people moving there. So just wanted to pick your brain on that.
100%. They are well poised. They're probably the best poised province in Canada and have been for a really long time, quite frankly. It's going to be their time to shine pretty darn soon. Since like, yeah, this is exciting. And I know many of you are investing there. And I believe that in today's intelligence report, it should come out, or it should have come out. There's an article that's just about Alberta and exactly that. Like it is poised to be far better off than others.
And that you think would last for, you know, a couple of years, like in terms of cycle where Alberta is it like at the beginning of the expansion? Because I know Calgary had like a pretty wild ride last year. Edmonton is, I guess, Vincent is still kind of following suit, right?
Yeah.
Yeah, we're typically about a year or two behind Calgary and we're more steady growth. With Calgary gets the swings. So I definitely, definitely, it's solid. The amount of growth we have, especially in technology and diversifying the industries that Alberta is going through right now. I see plates of Ontario and BC all over the place in Alberta right now. Just when you look at the cost for real estate between, Vancouver, the Vancouver area and Toronto area, Ontario, and you see where Alberta's at, we have a far more room for growth as far as appreciation goes, for sure. So I think we're posed for a few years. It's not even, it's way more than 5 years. Like we have a lot of catching up to do Alberta, so we got that room to grow.
So I guess Alberta, putting it all in one bucket, that's one way to look at it. But like I was just actually just looked at the rental.ca report, and Edmonton is like ranked 32 in terms of most expensive, and it's like average for one bedroom is like $1,000, and Calgary is like 1,600. Huge difference in like the rents. So do we think like the rents will continue going up, like catching up with Calgary, or is it gonna still stay kind of fairly affordable?
It's hard to because they also have a little bit different entrance points in terms of like there's the ROI. But as Vincent mentioned, Edmonton is a far more sort of steady. Calgary can fluctuate typically more. So yeah, you might see Edmonton kind of catch up a little bit in terms of rents. I wouldn't really focus on the rents. I would focus on the economic behaviors and the population and the jobs, because the rents always just sort themselves out, truthfully. And if you have those fundamentals, which both Calgary and Edmonton do, they just take different times to get there. And Edmonton is like a nice, slow, easy. And if you want to have Calgary with a little bit more excitement, it's kind of like, picking a dating partner.
Okay, that makes sense. Second piece is I guess the commercial mortgage rates. Like I know we're talking like residential, like tied to Bank of Canada rates. So in terms of bond rates, they kind of went down this morning when the interest rate went up. So where do we think in terms of if I know that there's a lot of knowledge here, if we were to like make a bet, where the commercial interest rates, like the bond yields, will be in 2024 or 2023, where do we think those would be?
I don't have that one off the top of my head. No.
You think would be higher or lower than what it is now? Let's put it that way.
No idea. Where do you invest right now?
Alberta, Ontario, and New Brunswick.
Okay, so you're well diversified. Yeah,
I try to be.
Yeah, so
but I'm leaning towards Alberta. Like I was there, did some some tours and met with Vincent, and we had a really good chat. And there's some potential projects that might come up, like developing like apartment buildings or whatnot. And so these are like really like the past week or two have been trying to make those calls, like where the interest rates are going to be, because with where the current interest rates are, like nothing is viable. Like I'm talking like development, but it's kind of trying to make a bet, like are they going to come down in like a year or two when your product is hitting the market?
You're talking more, I just want to be clear. Are you talking about like the bond rates, or are you talking about commercial interest rates? Like commercial real estate
they're linked, right? Like, so
they're linked.
Commercial interest rate is linked to the, I guess, CMB, they call it Canadian mortgage bond.
Yeah.
So that's what they're linked to. So if the yields go up, like the more commercial mortgage rates go up as well, right? That's how I understand it. I hope I'm correct, but
I would need to look into that further. What I would like to say is that a little special something about Alberta is that I don't know if you may or may not recall, but in last December, we did a research lab on Florida, and it was Orlando, Miami, and Fort Lauderdale. And it was our first research market analysis at that sort of Florida level, the city level there. And what really showed up was that, and I called Florida the state of great refuge. And Alberta is that province in Canada. Politics matter a lot. And that premier in Alberta is getting quite vocal about some things that are making Alberta be a lot more like Florida. And Florida is one of the most open, most growing, most expanding, driving people, jobs, all that. And I believe that Alberta is leading Canada in that regard. So I feel very, very confident in the Alberta market. I know that's broad.
I do agree that the policies and Vincent, we talked about that. Like Alberta is such a, like, I don't call it easy, but it's like a very encouraging place to do any kind of business. Everything it's a little bit easier to do, like experiencing Ontario and even New Brunswick in terms of, you know, dealing with governments and municipalities. Ontario, everybody knows it's like a nightmare. But yeah, Alberta is definitely a breath of fresh air.
Well, and even when it comes to cap rate, not cap rates, pardon me, rental caps and rental restrictions, right? Alberta is far superior than most provinces in Canada in terms of fewer taxes and fewer restrictions and all that. And it's just,
well, then no land transfer tax. That's the biggest thing.
There's a land tax. Correct. You're 100% accurate. And I always like to remind people that while there isn't a tax, there is still a fee. It's small, but it's a one-time fee. But there is something. It's just very, very nominal.
Yeah.
Just so that people don't forget it when they're doing their diligence. Oh shoot.
Yeah.
Perfect.
$1,000.
Thank you. Thank you, Ali, for your comments.
Yeah, no problem. Thank you for the
Yeah, thank you.
Thank you. And is there anybody else that has anything before we move along? I don't
Hugh's
see it.
raising his hand. That's
Who
not
is?
Hugh. Hugh
Hey,
raised
Hugh.
his hand.
What's going on?
Well, just want to say hi and everything else. And actually, Jen and I were talking the other day, and Naran, I think I'd love to meet up for a coffee or something, maybe, if you have time.
Where do you live?
I live in Midland right now, but I'm in the GTA quite a bit. So
Perfect. Let's make it happen.
Okay, sounds good. That's it.
Awesome.
That's it.
And
Okay.
it's been great, always great talking with you, Hugh. So always. And the rest of the community, just remember, we're all here. And I mean, while our REWL lounges are paused for a little bit until the new year, there's plenty of opportunities like now to ask questions and get to know each other. And certainly at our masterminds on Wednesdays, the first and third.
Yeah. Jennifer, Vincent, if there is nothing else, then I don't want to keep people beyond. I know people have got beds to get to, dinners to get to, and walks to go on, but whatever you plan on doing for the rest of the evening, at least for me, it's evening, whether you're catching this replay or Vincent, what time is it where you are?
Almost 7:30.
Almost 7:30. My goodness, we started at 7:30.
I know.
Okay. But before I let her, so if you're a REWL member and you know all what I'm going to talk about in the next 10 minutes, feel free to exit the call. I don't want you to feel like you've got to stay here. Loved having you and look forward to seeing you again at the next meetup, wherever that might be. I am going to take 2 minutes because I know that there are people that are brand new to REWL, and just walk you through a few highlights about REWL, in the hopes that you will not just be a temporary member, but that you will end up joining our community. Okay, so I'm going to share my screen, and let me see here. Oh, there we go.
Quickly, Dee Lee is asking if the replay will be available by email. I don't know about by email, but it's definitely available in your member portal. And if you need help getting into that, we can arrange that for you.
Okay, thank you. Jennifer, can you see my deck?
I
Give me
can.
a thumb.
Yeah.
Perfect. All right. So in REWL, we actually cater to a number of different types of investors. We cater to the beginner investor. If you, or maybe you've got a few properties and you're looking to like organize everything and scale up. And then on the third is the, the person that's got lots of properties, you're looking to exit or transfer it into some other vehicle that's going to give you cash flow. And so we help with all those three areas. But because if you are new to the REWL community and you are considering joining us, I just want to highlight a couple of things. One is the Real Estate Investors Toolkit. We have all kinds of things for all kinds of people. Like I said, you may be experienced, you may be a beginner, you may be next level. One of the things that you will find, in addition to the information that you have heard from us today, is that you're going to find we will be putting out research analytics and bullet points, quick facts that you can actually use on a regular basis. Now, here's the thing. This will do a couple things for you. One, it will cut through all the noise out there and crystallize everything for you very, very quickly. So this is, if you are a busy person like I am, I don't have time to be reading through a whole pile of material. This quickly gives me the facts. Secondly, guys, it makes you look like the rock stars of real estate, because you got this at your fingertips. So this is one of the advantages of being our REWL member. We summarize the news headlines for you. This is called the Members Only Intel Newsletter. We avoid what we also do is we avoid confusing spreadsheets. Now, I don't know, Jennifer, and I do this sometimes when I'm talking to somebody who's brand new in real estate. I always assume that they know more than they actually do. And I'll start talking about things really fast. And what happens is then this glazed look comes on their eyes and then they look confused. Instead of using huge spreadsheets, we have portfolio analysis that you can do. We have all kinds of calculators in our office that you can use that will simplify things for you, make you look super professional. We also have a what to do step-by-step playbook. If you're brand new, what kind of real estate investor are you? Are you a deal hunter? What kind of person are you? We'll help you analyze yourself first, and then we'll help you analyze the market, and we will help you analyze where to place your capital. We also provide unique and off-market deals in the property shop. So especially in times like this, if you're looking for a good deal, these are buildings and houses that has passed our first litmus test, so to speak. It's worth a second look. You still need to do your due diligence on it, but it has passed our initial, criteria. We do real estate investing starting guide. Now, and for all of this stuff, the toolkit is valued at around $2,000 a month. So here's the thing. Some of our REWL members are $99 a month members. They get everything. They have full access. They get everything. There are some of you that are starting off and you are $49 a month. And what you get is a starting out package. Plus you get coaching from or mastermind groups, coaching from it was Wendy and myself that was doing it on a weekly basis before. We're going to restart that again in January. That's at the $49 per month member. But if you have no idea whether you want to get into real estate or not, you just want the basic minimum, $9 a month gets you access to all the tools. And so we've got you covered regardless of what area you want to be in. If you'd like more information on this, Annalisa or Jennifer, if somebody from our office can just in the chat throw in a link for where people can go to get more information, and we would love to have you join, whether that's at the $9 a month, whether that's a $49 a month or the $99 a month. We would love to have you join. Don't try and do this on your own. That's it. And Jennifer, if there we go. Any past ending comments for me?
Oh my gosh, no, I just love what Olu said here. And he said it's more than worth the $99 per month. And I think that that's a huge testimony.
Thanks, brother.
Thank you, Olu. Indeed, there is a lot there. Most people can't get through all of it. However, as we get to work with you and mastermind, it's easier to direct you. And the more touches we have with you, the more we can help you in achieving your goals.
So Jennifer, let me put this in context. I'm a seasoned real estate investor. I know what I'm doing.
Yes,
the amount of information that REWL puts out is overwhelming for me.
Oh yeah.
Yeah, for me. So
Right.
there's lots of value. Like I can't get through everything.
And you don't need to.
You don't
really
need to.
don't.
Exactly. Yeah.
You just need to know who to call, who to email, and when to show up at your REWL meetings for the golden nuggets. So
yeah. Great. Well, everyone,
Awesome.
have
Thank
a
you, Ryan.
great night. I am so grateful for the capacity and the friendship that you've offered to us.
yes.
I know Jennifer and I are grateful for the opportunity, and Vincent, to serve you, and as well as Ken and Richard and our whole team at the Real Estate Wealth Lab. There's a number of us. Jennifer, any closing comments before we sign off tonight?
Thank you. One, you're asking if does anyone have any ideas how to start a property management company and create reoccurring income through it? 100% we do. 1,000% we do. And you need to come to our mastermind on Wednesday, where we actually have a property management mastermind group. So get in that, and you'll get all the answers you need. So thank you
Awesome.
very much. See you
Good
next
night,
week,
everybody.
everyone.